Hello and welcome to SRA Accounts Rules Compliance, where we're looking at the SRA Accounts Rules which came into force on the 25th of November 2019. My name is Jenny and I'm joined by my colleague Faye. Our contact details are on screen if you have any questions about this webinar. This webinar covers parts 1 and 2 of the SRA Accounts Rules. Part 1 is general and part 2 is client money and client accounts.
Rule 1.1 covers who the rules apply to. These rules apply to authorised bodies, their managers and employees, and references to you in these rules should be read accordingly. So they apply to all practices that hold client money of any amount at any time. There is no exception. They apply to the practice as a whole, including all those who work within the practice, whether it be a partner, secretary or the cleaner. Rule 1.2 says that the authorised body's managers are jointly and severally responsible for the compliance by the authorised body, its managers and employees with the rules. The rules define a manager as the sole principal in a recognised sole practice, a member of an LLP, a director of a company, a partner in a partnership, or in relation to any other body, a member of its governing body.
These rules now formally recognise multidisciplinary practices. So Rule 1.3 says, in relation to a multidisciplinary practice, the rules apply only in respect of the regulated activities and do not apply to out-of-scope money.
Rule 2.1 covers client money. Client money is money held or received by you, relating to regulated services delivered by you to a client. Regulated services has been included in the definition due to the SRA's attitude to acting as a bank. Client money is also money held or received on behalf of a third party in relation to regulated services delivered by you, such as money held as agent, stakeholder, or held to the sender's order, as a trustee or as the holder of a specified office or appointment, such as donee of a power of attorney, Court of Protection Deputy, or trustee of an occupation or pension scheme. Money held in respect of your fees and any unpaid disbursements, if held or received prior to delivery of the bill for the same. There is no longer any different treatment for professional disbursements. What if you only receive money relating to fees and unpaid disbursements?
Rule 2.2 says that in circumstances where the only client money you hold or receive falls within Rule 2.1d, which was in respect of your fees and any unpaid disbursements if held or received prior to delivery of a bill for the same, and any money held for disbursements relates to cost or expenses incurred by you and on behalf of your client for which you are liable, and you do not for any other reason maintain a client account, you are not required to hold this money in a client account if you have informed your client in advance of where and how the money will be held. So to summarise, if you only get money into your client account in advance of your bills or to pay for disbursements, you no longer need to operate a client account as long as you let your clients know that you are holding that money in office.
Rule 2.3 states, you ensure that client money is paid promptly into a client account. There is no definition of promptly, so firms need to decide how long. This should be set out in the firm's practice manual. For the majority of practices, this will be the same or next working day, but exceptions might be seen with rural locations when they wait for the bank's van to visit once a week or twice a week. Exceptions where this does not apply would be where to do so would conflict with your obligations under rules or regulations relating to your specified office or appointment, where the client money represents payments received from the legal aid agency for your costs, or where you agree in the individual circumstances an alternative arrangement in writing with the client or the third party for whom the money is held.
Rule 2.3 doesn't just cover the prompt banking of client money into the client bank account, but it also covers instances where client money is not paid into a client account, resulting in an office ledger credit balance, i.e. client money is in the office bank account. The SRA has released guidance stating that firms who review office credit balances on a monthly basis are adequate and on a weekly basis are above adequate. So you may wish to consider whether for your firm it's appropriate to separate the treatment of office credit balances from other client funds received into the business. The main causes that we tend to see for office credit ledger balances are credit notes being raised and reissued for a small amount, or the bills are not reissued at all. Refunds received, for example, directly from Land Registry. And clients, where clients pay directly into the office account rather than client in excess of the balance that's due. Or can be transfers where client to office transfers are performed in excess of the funds due on office, for example, for unpaid disbursements. Most systems have a standard report for this, but if not, you should review a full list of office ledger balances to identify any credits.
Rule 2.4. You should ensure that client money is available on demand unless you agree an alternative arrangement in writing with the client or the third party for whom the money is held. This rule means that any fixed term deposits should be accessible, even if interest would be forfeited in the event the money was needed to be withdrawn. You need to be really careful, as if a client asks you to place their funds on a fixed term deposit account so that they can achieve a better interest rate, you need to consider whether this would be acting as a bank.
Rule 2.5 is that you ensure that client money is returned promptly to the client or the third party for whom the money is held as soon as there is no longer any proper reason to hold those funds. So this is a rule covering residual client balances. Client funds need to be returned promptly on completion. There's no definition of promptly within the new rules. We find that residual client balances commonly relate to small amounts and often occur when a cheque payment expires and is not reissued. If a client receives a cheque for £3, they might not take it to the bank, as it often costs more to part these days. For very small amounts, for example less than £5, consider whether it be appropriate to send postage stamps instead of a cheque. Otherwise, see if you can contact the client and ask whether funds can be returned electronically or can be donated with their permission. We're going to talk about donating residual balances a bit later. For example, Rule 5.1 covers the prescribed circumstances in which you can withdraw client money from client account to pay to a charity of your choice.
Rule 3. Rule 3.1 says you may only maintain a client account at a branch or the head office of a bank or building society located in England and Wales. And 3.2 says you must ensure that the name of any client account includes the name of the authorised body and the word client to distinguish it from any other type of account held or operated by the authorised body.
Rule 3.3 says you must not use a client account to provide banking facilities to clients or third parties. Payments into and transfers or withdrawals from a client account must be in respect of the delivery by you of regulated services. We're going to be issuing a separate webinar on acting as a bank, which will include more detail on this rule, the SRA's case studies, and specific examples that we have seen.
Rule 4 is about keeping client money separate. So 4.1 says you keep client money separate from money belonging to the authorised body. And 4.2 says you ensure that you allocate promptly any funds for mixed payments you receive to the correct client account or business account. Under the 2011 accounts rules, the SRA recommended that in respect of mixed receipts, if in doubt, pay all of it into the client account and transfer the office element within 14 days.
Rule 4.3. Where you are holding client money and some or all of that money will be used to pay your costs, you must give a bill of costs or other written notification to the client or the paying party. This must be done before you transfer any client money from a client account to make the payment. And any such payment must be for the specific sum identified in the bill of costs or other written notification and covered by the amount held for the particular client or third party. Other written notification of costs could be an email, letter, or even a text, but it's important to remember that you will need to retain these with your other bills of costs. As the payment must be for a specific sum identified, it is not enough to give a general idea of the expected disbursements in the terms of engagement. We would always encourage you to send a written notification before making the transfer, detailing the specific sums you are reimbursing the business for.
Be careful. Importantly, the definition of costs still includes fees and disbursements, and therefore, as this rule states, you must give a bill of costs, and this must be done before you transfer any client money. Moving forwards, any disbursements will also need to be included on bills and sent before you can transfer the funds from the client account. The 2011 SRA accounts rules included a rule stating that funds earmarked for costs must be transferred from the client account to the office account within 14 days. This rule no longer exists, but it is important to consider what you will implement as your own internal deadline. Whilst extending 14 days might seem appealing from an administrative perspective, transferring money you are owed from client to office less than twice a month could be detrimental to the business's cash flow.
Rule 5. 5.1 says you only withdraw client money from a client account for the purpose for which it's being held, or following receipt of instructions from the client or the third party for whom the money is held, or on the SRA's prior written authorisation or in prescribed circumstances.
Prescribed circumstances have been released which deal with the donation of residual client balances. You may withdraw residual client balances of less than £500 on any one client matter from a client account provided the balance is paid to a charity of your choice, you have taken reasonable steps to return the money to the rightful owner. The reasonableness of such steps will depend on the age of the residual balance, the amount of the residual balance, if you have access to the client's most up-to-date contact details, if not, the costs associated with tracing your client. We expect you to make more intensive efforts to locate the rightful owner for larger or more recent residual balances, or for balances where more details are held about the client. For amounts over £500, you will need the SRA's authority before removing this money from the client account. They have an application form for this. You should keep a record of the steps taken to return the money to the rightful owner and retain those records, together with all relevant documentation for at least 6 years. When looking at returning residual balances to clients, you should record the steps taken to return the money to the rightful owner and retain those records, together with all relevant documentation for at least 6 years. You should keep appropriate accounting records, including a central register, which records the name of the rightful owner on whose behalf the money was held, the amount, the name of the charity and their charity number and the date of the payment, and all receipts from the charity and confirmation of any indemnity provided against any legitimate claim subsequently made for the sum they have received. You should not deduct from the residual balance any costs incurred in attempting to trace or communicate with the rightful owner. The records referred to previously may be requested by your reporting accountant, who will look at whether you have followed these prescribed circumstances.
Rule 5.2. You appropriately authorise and supervise all withdrawals made from the client account. Consider whether the person or people authorising transactions are appropriate and have a full understanding of the requirement of the rules. We would always encourage firms to have two-stage authorisation for withdrawals from the client account.
Rule 5.3 says that you can only withdraw client money from a client account if sufficient funds are held on behalf of that specific client or third party to make the payment, i.e. the client account must not be overdrawn. Individual client ledgers normally should not be overdrawn unless there's sufficient money held on a separate matter for the same client to cover the balance, or there is sufficient money held on a designated deposit account for the same client to cover the balance.
Rule 6.1 says that you correct any breaches of these rules promptly upon discovery. Any money improperly withheld or withdrawn from a client account must be immediately paid into the account or replaced as appropriate. Business managers do not always appreciate that it is their responsibility to replace funds that have been withdrawn from the client account improperly, whether that is because the firm has been victim of theft or a cyber attack, or simply because the account details on a payment have been entered incorrectly. If the funds are not replaced immediately, for example, the owners cannot afford to or are unable to recover the funds that same day, then the SRA may impose fines and other sanctions.
Rule 7.1. You account to clients or third parties for a fair sum of interest on any client money held on their behalf. Rule 7.2 says you may, by a written agreement, come to a different arrangement with the client or the third party for whom the money is held as to the payment of interest, but you must provide sufficient information to enable them to give informed consent. The SRA have confirmed to us that a written agreement to pay no interest is not considered to be fair, so you must have a policy to pay interest to clients. However, we are seeing for many firms with a de minimis level of £50, and you are only required to pay interest at the rate your client account could receive if they enter the bank and open their own account. You do not need to pay the same interest rate that you receive.
Rule 8.1 says that you keep and maintain accurate, contemporaneous and chronological records to recording client ledgers identified by the client's name and an appropriate description of the matter to which they relate, all receipts and payments which are client money on the client side of the client ledger account, and all receipts and payments which are not client money and bills of costs including transactions through the authorised bodies accounts on the business side of the client ledger account.
So, chronological postings are really important. You should avoid backdating transactions and reversals. You should ensure the accounts department is informed of transactions on the same day, i.e. bills should be raised, posted and sent out to clients on the same day.
You must also keep a separate ledger for every single individual client. Miscellaneous can be confusing if used for multiple clients. We often see miscellaneous ledgers set up for fee earners where they post disbursements, for example land registry fees, before the client's individual ledgers are opened. In practice, disbursements that are posted to miscellaneous ledgers are very rarely moved over to the individual client ledgers, effectively costing the business money. We would suggest avoiding the use of suspense or miscellaneous ledgers at all if possible. Ensure fee earners do not commence work until due diligence on your client is completed and the matter opened. You should not receive money from your client until you've completed your money laundering procedures.
So Rule 8 is essentially the net that catches any misposting. If the breach is corrected immediately, it's not a serious issue, provided it doesn't happen too often.
Rule 8.1 also says that you need to maintain a list of all the balances shown by the client ledger account of the liabilities to clients and third parties with a running total of balances. This is a standard report on most systems. We refer to it as the client matter listing. You must also provide a cash book showing a running total of all transactions through client accounts held or operated by you. Again, the client cash book is a standard report on most systems.
Rule 8.2 requires you to obtain at least every 5 weeks statements from banks, building societies and other financial institutions for all client accounts and business accounts held or operated by you. These can be in paper format or as a PDF.
Rule 8.3 covers bank reconciliations. It says that you complete at least every 5 weeks for all client accounts held or operated by you a reconciliation of the bank or building society statement balance with the cash book balance and the client ledger total, a record of which must be signed off by the coffer or a manager of the firm. You should promptly investigate and resolve any differences shown by the reconciliation. An analysis of differences between the cash balances shown on a bank statement and the amount shown in your records is important. Bank reconciliations should be prepared to ensure that your cash book postings agree to the bank statements and that your primary entry books are correct. If there are differences on the client bank account, then you cannot be sure that all matters relating to client money have been recorded, which may result in major breaches of the SRA accounts rules.
What about office account bank reconciliations? There is no requirement under the rules for office bank accounts to be reconciled, but it is a good control. If there are differences on the office bank account, then you cannot be sure that your practice accounts are correct. There is currently no requirement for accountants to look at the office bank reconciliations, but we do when we carry out our audits.
Rule 8.4 requires that you keep readily accessible a central record of all bills or other written notification of costs given by you.
Thank you for listening. This is the second in a series of webinars covering the 2019 SRA accounts rules, so please look out for the next instalment. This will cover parts 3 and 4 of the rules. Our contact details are on the screen, so please get in touch if you have any questions.